All right, let's get into some very basic charting anatomy here. So as you guys can see, this right here is a bullish green candlestick. What does that mean? Okay, it means that the candlestick opens right here. It at some point during this time frame's duration manages to go all the way to down here, manages to go all the way up here. So this is the range of the candlestick, is from this high to this low, and it closed here. So what does that mean? It could have opened, went lower, went higher, and then went a little bit lower and closed. Or it could have done something like this, and then this, and then this, and then this. It could have done whatever. But the point that what we care about is where it opened, where the lowest wick was, where the highest wick, where the highest wick was, and where it closed. Similar with the red candle. A red candle opens here. At some point, it managed to go all the way up here. Again, at some point, it managed to go all the way down here, and then it closed right here. So moving forward, what is this? A high. What is a high? I move up, which is a green candle, followed by a move down, which is a red candle. So when we have this formation of candlesticks next to each other in a sequence, we don't care what happened before or after this, this is a high. Now, where do you mark the high specifically? Right here. You take out of these two candlesticks for a high scenario, the highest wick of the two. If the red wick was up here, I would take the red wick. But since the green wick is higher than the red wick, candlestick wick, then it is going to be where we mark out our horizontal ray for our high. Now, for the opposite, I literally just took this image, flipped it 180 degrees, okay? What does this mean? So for a low, red candle followed by a green candle, same exact scenario as before. What do we take the lowest wick? Guess which one it is? Yep, it's that one right there, okay? So this is extremely basic charting anatomy, and you need this to understand liquidity sweeps, which is what I want to get, which is the concept that I want to get into in this video right here. Now, I just simply cut to TradingView. I don't have anything prepared. I'm just going to show you guys in real time me walking through liquidity sweeps that are presented throughout the market every single day. Okay, so I'm on the 1 hour time frame, as you guys can see. You guys are seeing the same exact candlesticks. Now, my up candlesticks are white, my down candlesticks are black. I did this for my psychology. Red and green is very psychological, and you know what I'm saying, for my emotions and all that stuff. So I made it simple. It looks clean. My background's white, right? So yeah, I hope this doesn't confuse you guys. So right into it. What is a liquidity sweep? I'm going to show you guys on the markets directly. So when we have a high, and okay, this is a high, okay? When we have this, a liquidity sweep is super simple, yet it is one of the most important foundations in trading, and in my strategy specifically, and in pretty much everyone's strategy, and like how we trade. Like that's why we're marking out charts, right? So when a high gets swept, that's a liquidity sweep. What do we expect to happen after a liquidity sweep? Reversal. Why? Because I'm not going to get way too complicated. You guys can Google this, whatever. But basically, whenever there's lows in the market, like this, there's a low, there's a low, there's a low, and there's a low. Retail traders, enter buy positions after every single low happens, thinking that was the lowest point where we're going to go higher. Buy positions here, buy positions here, buy positions here. Now, why does that matter? Because every time someone enters a buy position, their stop losses are usually going to go at lows. So they're going to go at these lows here, these lows. If I enter buy here, because what retail traders think is, I'll make it very simple for you guys. So let's say we have this move and this move here. A retail trader sees, hey, we broke structure to the upside. We're going to keep going up, right? And so they enter right here where we break structure, right? Roughly here is where they're going to be entering, and they're going to be placing their stops around or a little bit below these lows. And their take profit doesn't matter, but you know, that could also be another point of reversal, but either way, we're talking about the lows here specifically. And so how do the markets move, and how is liquidity generated, and what is the pretty much the foundation of how the markets move? Liquidity. So liquidity rests at stop orders, rests at orders in the market. Here you have an influx, a large influx, a large amount of sell, or if you're in buys, you have a large amount of sell orders right here resting below lows. And in order for the market to actually move higher, And in order for the people who, the institutions who move the markets to buy, like, okay, look, the institutions who move the markets need a lot of money to move them, right? Millions, billions of dollars, okay? Here, there's not, and in order for someone to buy, someone has to sell. So if they want to buy $1 billion here, someone or many people collectively have to be willing to sell $1 billion of their positions here. But here, no one wants to sell, right? Because price is going up. Obviously, more people are going to buy. So in order to get people to sell, they need to push price down here where a lot of people are willing to sell because they have sell orders resting there, to then be able to fill all of their orders, which will then in turn, in the long run, or not even long run, just like overall, make price actually go higher. So that's just the reasoning behind that. Okay, let me remove all this right now. A lot of drawings right here, a lot of them, my bad. All right, so we have the markets right here. 1 hour time frame, you guys can see choppy. We have a bunch of so many highs and lows. All right, so right here, let's get into it. What is this right here? What is this right here? This is a high. This is a high, okay? A move up and a move down. It's a high. What does price do? It comes up, sweeps the high, gives us legs lower, okay? Liquidity sweep, reversal, all right? What is this right here? This is a low. In fact, these are stacked lows. What does this mean? It's many lows stacked. So we have many lows right here. Low, 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 low. Now, yeah, okay. And price went all the way down here. It filled all the orders. Liquidity sweep, reversal. Okay. Let's go right here. Liquidity sweep, reversal. Liquidity sweep, reversal here. Okay. Let's go right here. Very, very obvious. Liquidity sweep, reversal. Literally the next candlestick out after that. Right here. It's a low. Price comes down, sweeps liquidity. Okay. Reverses. Here is a low. Price comes down, sweeps it, reverses. Here is a high. Price comes up, sweeps it, reverses. So not all the ones work. For example, this one here, this is a low, right? You see how price ran right past it. This is why we have strategies in trading and why we have entry criteria to be able to understand and to be able to understand which liquidity points actually matter and which ones are actually going to cause reversals. So for example, this one didn't, but you also shouldn't enter here because you don't want to, like, if price is just going all the way low or not giving you reversal signs, then you're not going to take that. So there are a lot of, it's not that easy because there's fake outs, there's breakout, like there's so much. So not all of them work, obviously, or else, like, come on, that'd just be way too easy. But most of the times, if you follow this strategy, which I'll make a video soon on my strategy, the liquidity points get hit, and that's what causes price to reverse. So this video was pretty much that. Let me know if you guys want to see any other videos, and I'll see you guys in the next one. I'm out.